Today, I want to walk you through what's happening in the truckload market right now, why capacity suddenly feels so tight, and how this doesn't just affect freight, it also ripples through the broader economy. 1. The big shift. Demand versus supply. Let's start with the core problem. Demand has taken off a lot faster than supply. Recent spot market data shows that spot load posts are up roughly 150% week over week. Spot truck posts are only up about 28%. So way more freight is being pushed into the spot market. But the number of trucks showing up to haul that freight is barely moving in comparison. That imbalance is the engine behind everything we're seeing right now. 2. Load to truck ratios, 20-to-1 and 50-to-1. Because of that imbalance, load to truck ratios have climbed to some pretty extreme levels. For vans, we're seeing around 20 loads for every one truck. For flatbeds, in some areas, it's as high as 50 loads for every one truck. That means for every truck that pops up, there's a long line of loads waiting to be covered. In a market like that, carriers can be very selective. They'll gravitate toward the highest paying freight, the easiest freight to work with, the most efficient routes and schedules. For shippers, that translates to capacity evaporating early in the day, more rejections and last-minute changes, faster, sometimes daily, movement in spot rates. 3. Negative truck growth. Fewer trucks, more freight. Now here's the twist that makes this even tougher. We're not just dealing with strong demand, we're also seeing negative truck growth. What does that mean? Some carriers are exiting the market. Others are parking trucks because operating costs and prior low rates squeeze them too hard. New trucks and new carriers are not entering fast enough to replace what's leaving. So you've got more freight and fewer active trucks. That's the classic recipe for tight capacity, rising rates, less flexibility when you need coverage on short notice. 4. How this hits your freight specifically. If you're moving freight, here's what this environment really means. 1. Service risk is higher. Tender rejections and late fall-offs become more common, especially on difficult or time-sensitive loads. 2. Rate volatility increases. A quote that looked fair last week can suddenly be underpriced this week as the market moves. 3. Execution risk goes up. Tight appointments, long load times, limited access, or extra handling. Carriers either price that in aggressively or just pass. This is where having a broker actively managing your freight and carrier relationships makes a big difference. You need real-time decision-making, not just a static rate sheet. 5. How it spills over into the broader economy. Trucking is often called a leading indicator for the economy because almost everything we buy touches a truck at some point. When load-to-truck ratios spike and rates rise, it doesn't just affect logistics teams, it affects the broader economy in a few key ways. 1. Cost of goods pressure. Higher freight costs raise the delivered cost of raw materials, parts, and finished goods. Businesses then have two choices: absorb those costs and accept lower margins, or pass some of it on through higher prices. Either way, it affects profitability and can contribute to overall inflation. 2. Project timing and investment decisions. When rates are volatile, companies may delay projects, slow down expansions, or rethink where they source and manufacture. Industries like construction, manufacturing, and energy, especially those relying on flatbeds, feel this quickly. 3. Business stability and employment. Carriers leaving the market or parking trucks is a sign of financial stress in the transportation sector. That can lead to business closures and job losses in trucking, and it can also create future capacity shortages if demand remains strong while the fleet has shrunk. So what looks like just trucking on the surface actually ties directly into prices on shelves, project timelines, and even job markets. 6. If you're quoting freight to your own customers. Now, if you're quoting freight as part of your pricing to your own clients, this environment comes with extra risk, unless you protect yourself. Here are a few best practices we strongly recommend. 1. Use clear freight disclaimers. Make it clear that freight charges are based on current market conditions and may change. 2. Limit how long freight rates are valid. In a fast-moving market, we recommend that freight rates are only guaranteed for 7 days from the quote date. After 7 days, they should be reconfirmed against the current market. 3. Quote freight as prepaid and add. Listing freight as prepaid and add gives you flexibility to pass through actual transportation costs rather than locking yourself into a single static number when the market is moving. Here's an example of language you can use in your proposals or quotes. Freight terms. All freight charges are quoted as prepaid and add and are based on current market conditions. Freight rates are valid for 7 calendar days from the date of this quote and are subject to change thereafter. Any adjustments due to carrier availability, accessorial charges, or market volatility will be communicated and passed through accordingly. That kind of clarity helps protect your margins and sets the right expectations with your customers. 7. How Whitewater Freight helps you navigate all this. Here's what we're doing on our side to help you stay ahead of the chaos. We prioritize your freight with our core carrier base, so you're not at the back of the line when capacity tightens. We monitor load-to-truck ratios and market data daily, so we can alert you when certain lanes are likely to move on price or service. We help you build smarter quotes with the right assumptions, disclaimers, and structures so you're not exposed when the market shifts. 8. Wrap up. The short version is this: more freight, fewer trucks. Load-to-truck ratios at 20-to-1 for vans and up to 50-to-1 for flatbeds. Negative truck growth tightening the screws even further. All of that drives higher freight costs, more volatility, and real economic effects beyond just logistics. If you want to walk through how this impacts your specific lanes, your quoting strategy, or your customers, reach out. We're here to translate the market noise into clear decisions and keep your freight and your business moving. Thanks for watching, and we'll keep you updated as conditions evolve.